So how often have you asked yourself, how does my money manager choose my portfolio allocation? I mean, why did they buy this stock or this fund? I mean, have you ever wondered if there was any real method behind their selections? When Warren Buffett was asked how to invest, he said, you don't have to have a stratospheric IQ or unusual business acumen. You really only need two things, he says: an intellectual framework for making decisions and the ability to prevent your emotions from corroding that framework over time. Eugene Fama, the 2013 Nobel Prize laureate, said essentially the same thing. He said, you don't pay attention to returns in the short run, 3 to 5 years. They're meaningless. He says, you need a long-term strategy and then stick to it. So don't bounce around based on news reports or economic predictions. Don't try and anticipate the market. There's no academic evidence this does any good. Potential clients have asked me what it is that makes us different. And I'll tell you, it's sort of like a chef at your favorite restaurant. You know, that restaurant that you love to go to because they make the meal exactly the way you like it. They use the best ingredients. They use a tested recipe. And you go back each time expecting the same meal. So based on our assessment and experience, we've selected, as your chef, the best ingredients and the best recipes that we know of to make our portfolios work for clients. As your trusted investment advisor, our proprietary recipes are based on the research from 5 Nobel Prize winning academic papers. And we use what we believe are the best ingredients. Our ingredients are mutual funds that are market-based, institutional funds that are priced like ETFs and low-cost index funds. So let me give you a simple example. Our domestic portfolio is currently made up of 5 funds with over 7,800 stocks held collectively across the United States investment spectrum. We generally allocate client portfolios in 5% increments to each of the 5 funds. And so this creates the possibility of 3,125 different investment portfolios. So which one's the best one? How could anyone possibly know unless they tested each one of those portfolios over a 40 or a 50-year time frame to see how they had done? So that's what we seek to do. We're trying to find the optimum allocation with the least amount of risk based on our clients' risk tolerance. Our intention is that this should give our clients the best results over the expected investment time horizon. But obviously there are no guarantees. Past performance is an indicator, but not a predictor of outcome. So here's what a simple test would look like. See all the dots? They are measured results from each of the 3,125 combinations. We're then able to pick up the best alternative and, based on the defined risk profile for our client, figure out which allocation would make the most sense for them. This method is called the efficient frontier and is based on historical data and scientific testing, hypothesis testing. We can only know what happened in the past. We can't know what's going to happen in the future. But in the academic literature, this method is called the expected return analysis, and it has the highest probability of delivering a similar result over a long time frame. You remember Gene Fama? You remember what he said? He said, you can't rely on 3 to 5 year returns to tell you anything about the market. You have to go out much longer than that. So if you'd like to see if your portfolio is on the efficient frontier or anywhere near it, contact us, and we would be glad to provide you with a free evaluation. Just mention that you heard about our expected return analysis from our electronic business card.